Very good. I haven't had the experience with the new builders. I haven't worked with loan or lenders, preferred lenders by the new builders.
Most of them have a cookie cutter guidelines. They
Right.
have overlays because most of the builders have their own banks.
Okay.
So they have to protect their asset, they have to protect their investments. So they're very cookie cutter. They don't think outside the box.
Yeah,
And that's how I get most of
Yeah,
the
it's-
builder clients. It's
right.
because it's a simple tweaking and it'll work. They can get their home. They don't have to lose their earnest money deposit.
It seems like they don't even they don't try to work with the client. They're not, just different from you. Because, like I said, through my experience with you, you seem, genuine with your feeling when you
Thank you.
give advice. I know right now maybe it's not a good time, but here, let's do this.
Good morning, guys. This is Clark Ong, and we are with the CK team. And today we have a special guest, and that is Ate Kathy Tan. So Kathy has been a loan officer. She has been a loan officer with our team for a while. My experience with her was that whenever I have clients who are having problems with getting approved for the loans, let's say they go to a new construction have their own lender, and turns out they couldn't get approved, I get her to talk to Kathy right away, and many times she gets them approved. That's me personally. We have used her services when we were purchasing a new construction home, the house that I'm living in right now, and the lender pre-approved us. Then when the house was built, they said, no, we can't approve you. Sorry, guys, because your wife has a student loan that just came up. So we went with Kathy, and she got us approved, and then we got us a lower rate. So that's pretty much my experience with her. It was great. How about you?
Yeah, I also used Kathy during my refinancing. That was about 2 years ago, I
so.
think. Yeah.
Yes.
And it was a great time to refinance. But as we used her, she made it the smoothest transaction ever. I hadn't even met her. There's no face-to-face meeting. It was. No, I've met her since, but that was really nice. Talking to her on the phone, and she did all the stuff. I've never refinanced a home. That's my first time ever doing it. And yeah, she is very knowledgeable about the current rate back then. The market was, we were like in the low, below 3, sub 3.
Was that during the
interest
pandemic?
rates? Yeah.
Yeah.
So
Thanks, guys.
she talked to me and explained to me like, oh yeah, historically the rate back then was like unheard of. So I'm like, oh, so I guess it's a great time. And she go like, yeah, it is. So, but that's my experience using Kathy.
Yes.
And
Guys.
I've used her with some of my clients too, and they said the same thing. Like easier to work with. I don't know if because we are from the same country, but it's still, I remember we had that one client where the agent was kind of like,
It was difficult.
yeah, difficult, and
Challenging. We use the word
she
challenging.
handled it like a champ. So. But,
Yeah, and just like not because someone has a license as a real estate agent means that they could sell a home. There's a lot of things there's a lot of factors to see towards negotiation, towards knowledge, intricate knowledge during the transactions. The same thing goes with loan officers. Just because someone is a licensed loan officer means that they could close on the loan. A lot of lenders out there would just tell you what you want to hear, but then by the time you're under contract and they see this, and this, they don't know how to navigate through it. And Kathy has always been upfront. If the person could be approved, she would know it right away, and she would tell us right away. She would tell the client what needs to be done for them to be approved. So. That's our introduction. I'd like to introduce Kathy Tan.
Thanks, guys.
So, Kathy, can you tell us where you're from and when did you come here to Vegas?
I'm from Laguna, Philippines. It's a province in the Philippines. I came here when I was in second year high school or eighth grade, which is a long
Just
time
yesterday.
ago in 1988. Long time ago. Were you guys even born yet? Probably not.
Probably. Yeah.
Yeah.
That's awesome. So can you tell us your experience when you first came here in the U.S.? I'm not gonna say how old you were. I know you said you were in second year high school.
Second year high school.
And is that Philippine?
Yeah,
Why
Philippines.
is that so?
Yeah,
You're
so I came here directly to Las Vegas.
Nice.
So in 1988, as you can imagine, there's nothing.
There's
Nothing here.
They were building the lakes area. I remember we drove there, we looked at it. We couldn't believe it. They're gonna actually build a housing development here and build a lake around it.
Okay.
So, Flamingo DMV was just the DMV and it's the desert. There's
There's nothing
nothing.
else.
I remember my dad came home one time and said, "Oh, we should buy this house." They said it's in downtown Las Vegas. They're selling it for $5,000 each.
Nice.
Can you imagine that?
$5,000.
My mom thought it was
Like
crazy.
auction.
Yeah, and my mom thought it was crazy. No, you're crazy. I'm not gonna live there. Those houses, they're not gonna be used to anyone. Well, look at it now.
Yeah.
Yeah, yeah. I think with downtown is kind of 50-50. 50% great, 50% not so good. But what made you, when did you start as a loan officer?
I started when my daughter was in second grade. It felt like I was missing out so much. So I wanted a job to where I can be a mom and I can also work full time, make the money. And at the time I was working for a dental office, I was also dealing with clients. And I just love dealing with clients. I love solving problems. I like it when they get their house and it's
Right.
everyone's so happy.
Yeah, when many times, a lot of us realtors, when we became a real estate agent, we didn't have a great experience when we purchased a house. And we said, we could do better than that.
Yeah.
Or we could be as terrible. But what was your experience in purchasing a property? What year was that when you first bought a house?
So I bought my first home in 2004. I was a single mom. It was an FHA loan. Nothing was explained to me.
Nothing.
I had an agent who write the check, we're gonna give it. And me as a single mom, I just wanted to get out of the apartment. I had a horrible neighbor. I want my daughter to be in a safer house, So I wrote the check, I went there, and it was actually an attached home.
Oh, it's like a
Yeah, it's like a townhouse. So I said, I don't want this. This is the reason why I don't want to be in a condo. And he was just so pushy. And I said, okay, fine, I guess. But I couldn't sleep. So I called him the next day and I said, you know what? I can't do this. It was just a horrible house. So I drove around with my dad, actually, found another house. I still use the same agent because I had no knowledge. I don't know what was going on. And so, I bought that house. My rate was 8.875. 8.875. It's an FHA loan.
2004.
Yeah, nothing was explained to me.
Oh, wow.
Yeah, nothing. I just signed it,
Yeah.
and it's, I was happy.
Yeah. Just for those of you who don't know, typically, especially if you deal with loan officers like Kathy, with a pretty good reputation, whenever they get pre-approved, they already get they get presented with facts and what are things to do, what are the things not to do. Once they come with us as realtors, we do a presentation with them. And it explains them everything that they could do while they're under contract. What are the things that they need to check for? What are the due diligence period? When are you going to do inspection? When are you going to do appraisal? When will you get your loan approved? what are the do's and don'ts. This is especially with the loan officers. They tell you what are the do's and don'ts when purchasing a property. Like, don't buy a car, don't co-sign for a car, especially if you have a loan. If you're buying cash, great. But if you have a loan, don't co-sign for a house or a car during the transaction. And I guess that was one driving force for you to become a loan officer.
Yeah, I really want to be the person that you would go to.
Right.
I know some of our clients would sometimes, they would text Clark or they would text you about loans. I don't know, maybe they feel like, oh, maybe I'm asking too much questions. And I'm like, why are they calling you? Call me. I want them to go to me. And I always answer my phone, even if it's at night, even if it's early in the morning. If I don't get to it, I'll get to you. But just please go to me if you have any questions, because I want that rapport with the client. I want you to feel comfortable with me. It's a 30-year commitment, so I want it to be out in the open.
That's pretty good. Yeah, I could attest to that. And it makes our job as realtors pretty good because we could just focus on the negotiations and everything about the loan. We give it towards Kathy. A lot of times, and this is towards like new construction lenders. Sometimes the older lenders go by the book, and their questions, whenever they have questions about the loan, they ask me, and I said, okay, you have to direct this question to the loan officer. Oh yeah, we already did. They never answered for a couple of days. So then I have to go and call the loan officer, and I answer questions based on what I know, and a lot of times it's during the settlements or during the closing disclosures, like how much money are they gonna come up, how much money do they have to go, and if their loan officer is not answering, these are for the new builds, then I go ahead and do my own calculations. But then I tell them this is not the exact how much, but this is just the estimate from my end. And I really wish the loan officer would answer their questions. So that's that. But that's why I appreciate loan officers like Kathy here, because she answers all the time.
And you guys could ask me, even if I'm not the one. And I always told you this: even if it's not my client, if it's a question that you need answered right away, guys, ask me. It's okay.
It's awesome. Yeah.
I have clients that I pre-approve and they went to the builder. I don't blame them. I want our clients to be happy. We're not fly by night. We want to be there for a very, very long time. They want us to refer. We want them to refer us to their friends and family. So, a couple of questions, even if it's not my client, it's not gonna hurt. If I know the answer, why not?
That's very good. I haven't had the experience with the new builders. I haven't worked with loan or lenders, preferred lenders by the new builders.
Most of them have a cookie cutter guidelines.
Right.
They have overlays because most of the builders have their own banks.
Okay.
So they have to protect their asset. They have to protect their investments. So they're very cookie cutter. They don't think outside the box.
Yeah,
And that's how I get most of the
it's-
builder clients. It's
right.
because it's a simple tweaking and it'll work. They can get their home. They don't have to lose their earnest money deposit.
It seems like they don't even they don't try to work with the client. They're not, just different from you. Because like I said, through my experience with you, you seem, genuine with your feeling when you
Thank you.
give advice. I know right now maybe it's not a good time, but here, let's do this.
Yeah.
On the other hand, I just had one client that I had actually directed to one of the new builders, and she got an email, and that was it, So I'm like, oh, it seems like, not the way to do a good business.
Yeah. Also, that's one of the reasons. So I know a lot of the agents of builders. I work with a lot of builders. I close a lot of new construction here, and I know a lot of the sales agents with the builders, and they always prefer. So when I'm there, they already know it, and they have no problem with talking to me. And they prefer that I'm there with clients. They prefer most of the time. They prefer the client comes in with the realtor, because before I take a client out, I make sure they're pre-approved, and whether it's a new home or a resale home, because if their lender couldn't perform, our lender could do the loans for this client. So they get their sale whether or not their lender could perform. So which is why they prefer that a client comes in with their realtor, because they're already, most of the time they're pre-approved. So interest rates right now are in the past 3 years, I would say now it's like an all-time high.
I'm high. It's like in the 90s. Again,
In the 90s, okay.
in the 90s,
Can you explain to us about
where
that? You've
the
been
prime
here.
rate is high. So when the prime rate is high, the interest rate is high. The prime rate is what the federal government set, plus the cost of the loan, the interest rate that they charge. You add that. So prime rate, I think, is at 5.25 right now.
Okay.
5.25 plus 3%. 3% is what you add for doing the loan, the cost to do the loan.
Okay,
So you're like looking at 8.25. Theoretically, when the rates are high, when debts are high, people are less to spend, and that's how they're trying to control the inflation.
Okay.
That's
So this is during the 90s.
during the 90s. It's
And
it's
then-
in the 8s and 9s, and then year 2000, I think we went down from maybe 6, 8,
Okay.
depending on what type of loan. Of course, it's different for every state. Different loan criteria. Is it primary loan? Is it investment loan? So it's different.
Okay. I remember when I first bought a house, it was 2015. I think my rate was 3.875 in 2015, and then in 2016 rates went down to like 2.9.
Wow.
But there was no loan officer who told me to refinance. So I should have just refinanced, buy on an FHA loan. So, okay, so some of the sellers are worried about FHA and VA loans. There's a lot of misconceptions on FHA and VA loans. One thing is that they think that it is a tough loan to close.
Which is not. I love doing FHA and VA loans, guys. All day long, I would do VA and FHA loans. I think the seller side, they're worried about appraisal. They have this misconception that, it's FHA loan. They have so much more, they look for, they nitpick on the house. It's not true. It's, they maybe they go up in the attic. I don't know. That's FHA. But other than that, there's no difference. The only thing is, yes, when there's an FHA appraisal, it follows the value of that house. That's the value. But pretty much when an FHA appraiser go up to your house and a conventional, the value is the same. It's not,
Just a little knowledge is that for FHA, they do have certain guidelines. Number one, the appraiser makes sure that the house is safe, because they don't want the FHA buyer to move in and then move in an unsafe house and then pass away, right? So they make sure that it's safe. Smoke detectors are working. Double strap for water heaters.
gas is working.
Gas is on. Flooring is steady. Rails are steady. There's no rotten wood on the fascia board. And these are things that needs to be done anyways.
Exactly. You don't want a brand new, a family with little kids going in the house and something's falling.
And these are not unreasonable. So the FHA are government-backed loans. So that means if the buyer defaults on the loan, the government pays the lender. Pays the lender for it. For VA loans, aside from what I've said, there's all VA loans have a termite inspection. I've yet to see a property here in Vegas that has that's termite.
That's termite. I haven't either. In 18 years,
Yeah.
there's none.
Yeah.
I mean, it's so dry and hot here. I don't think they could survive. I don't
Speaking
know.
about that termite, I had that termite inspector comes over to my house, and goes in the back around and then comes back to me and like, oh, you got like termite infestation. I'm like,
What?
and so all this time
This is
I
the
didn't
first
really
time I've
introduce myself to him as a realtor. Not that I know a lot about termite, but I know for a fact that I've seen termite like the termite.
We have a lot of
the
termites in the
So
In the
Philippines.
Philippines.
when he
yeah.
showed me he was like, yeah, this one's a termite. I'm like, oh really? I'm like, I don't know. So
Well, that happened to my client too in Summerlin. They said that, oh, you guys have termites, and they called me and said, okay, here's a pest inspector, and then the pest inspector came in and said, yeah, there's no termite. There are houses that fail termite inspections, but doesn't mean that they have termite. It just means that, like for example, they have there's the foundation and there's the soil. The soil is too close to the foundation or is touching the foundation. That would increase the risk. So that happened with one of my sellers. So I went in there with my shovel and just stick it all in.
I think I remember you doing that.
Yeah, the video.
I think I remember you.
I was sweating. I wish I could have just hired a landscaper to do that. This was in North Las Vegas. Yeah, but they didn't find any termites. It's just it didn't pass the termite inspection. So, but yeah, that's about it. They also do have a for VA loans. They have a what you call it, the a certain disclosure on appraisal on what you call the red tide, right? Red tide, is it? So it's when if the property did not appraise, they have the opportunity. The agents have the opportunity to present their own comparables.
Okay.
Yeah. But a VA appraiser and the FHA and the conventional appraiser will, assuming that the comps are the same, they're gonna come up with the same value most of the time, and not all the time. I mean, we have some situations where there's just a different appraiser on the conventional loan, but there's different values. So it all goes down towards the negotiations. Anyway, so
you could always rebuttal it. You could always try to come up with more comps, but pretty much it's like the appraiser admitting I made a mistake. So it's
yeah, a lot of them have a pretty high ego that they wouldn't.
yes.
They wouldn't admit to their mistake, and a lot of high ego because there's not a lot of appraisers around.
So we're speaking about appraisers. You as a loan officer, what is your role, like in facilitating the process of the home buying process? I know you get in contact with the realtor, the agents, and also the appraisers.
So we have it's called an AMC. I cannot contact the appraisers anymore.
Okay.
Because of what happened when the mortgage crashed. I think we'll get to that later.
Yeah.
So they have to inform our office if I contact them. I can get in trouble. So it's always I have to email my assistant. My assistant has to email the AMC. AMC get a hold of the appraiser if there's a question, and everything has to be recorded.
Yeah, we can't bribe the appraisers. So what do you mean? So there's I think there's 3 appraisal management companies here in Las Vegas, and then depends on the lender, they're affiliated with one. So once there's an appraisal order, it goes to the AMC. AMC schedules it and randomizes the appraiser that goes there. So there's no contact between the lenders and the appraiser.
There's no favoritism.
Yeah, they couldn't. The only time we could select our own appraiser is if it's not in contract. Let's say there's a probate case. The seller passed away in the property, and for probate they have to get the appraiser and what's the value on the property by the time that the seller passed away. Then that's a private appraisal. And if you're bored, you want to get an appraiser in, spend $600. Hey, can you appraise this property?
I think I've heard
could
that
be it too.
very common before I became a realtor, working at casino. A lot of time we heard this conversation like, get your house appraised, get your house appraised, So I didn't understood then
What's
what they
the
were
reason
trying
for
to
getting
say,
it appraised? If you just want to know, you could look at Zillow and then you
Appraisal is on
kind of
sale.
appraisal is on sale.
But that is good to know that there was, there's no in cahoots or anything going
Oh,
on
no.
between,
Oh yeah. You couldn't. A lot of times they don't even like the realtor to meet them. I try to meet them. Like for example, if it's a custom home, you know, um, I don't put the lockbox. I take keys off the lockbox, so they have to contact me because I have to tell them, what are the custom things that the seller has done on this property. What are the comps that I have. I don't show it in their face, but I showed, hey, this is just for your information. This were the things that they've done. These are the comps that I found. It's up to you, and then leave them. But I have to make sure that I'm there, when the appraiser is there for the seller. So, like I said, there's no just because if it's an FHA or a VA doesn't mean it's gonna appraise less versus a conventional loan. Now, let's talk about investment loans.
Okay.
So a lot of times, a buyer would come in and say, "Hey, my credit is shot. I'm self-employed or blah blah blah, but I saw this deal property, right? It has a tenant already, and is there a way for me to get approved? With a bad credit, but with an income-producing property."
So there's a program, there's the SCR. So the SCR basically use the income of the property to offset the ratio. Now it depends on how bad the credit is because the SCR also has a requirement on your credit. I think the guideline calls for at least 620.
Okay.
But with the high interest rates right now, you're probably looking at a really high rate. Plus, you need to put down at least 20%.
Okay.
And because you are an investor, it cannot be a gift. That money has to be in your account for at least 2 months.
Okay. So the SCR means debt service coverage ratio. So the income of the property covers the debt,
The monthly payment.
the monthly mortgage.
Yeah.
Now, let's say this is a buyer. Let's say take into consideration the buyer just moved career to a different, not a lateral career, but like a totally different career. She went from let's say being a nurse to being a blackjack dealer, something like that. Or OnlyFans. Who knows? But 6 months.
We have to see records.
Yeah. So typically lenders want 2 years,
2
2 years income tax returns on that new career that you have, or a YouTuber. Who knows?
Right.
Like went from this career to the other one. So let's say their credit's 620. And then they found this deal, they found a property that, it has this income that could cover if they come up with a 20% down, because they get a lot of tips from their subscriptions. And so that person could be.
So the SCR is the best way to go because I don't need to see your tax return.
Okay.
I actually just pull credit just to see your score. I don't even have to put anything else.
Right.
So that's the perfect loan for someone that's wanting to start investing.
Okay.
Yeah.
Very nice. Next question would be, there are people who buy a home as a second home, and there's people who buy a home as an investment home. So what's the difference?
A second home is in our world. Second home means vacation home. That's where you go. That's a second home. So for us, Nevada and Las Vegas, you could buy a second home in Mount Charleston because you could. It's a recreation place.
Oh, okay. So it
Yeah.
doesn't have to be like 100 miles.
No, so that's one thing that we were able to pass through because hey, I have a house here, I'm a nurse here, I live here, but on the weekends, I like to be away from the city.
Right.
So we drive up to Mount Charleston. So we can consider that as a second home. Yeah.
Wow.
Right? So start
Now,
selling
there's
houses
a
at Mount
flood
Charleston.
Right now in Mount Charleston.
Oh, I
Yeah.
saw that.
You can go there right now, but I'm not sure how it affected the property values. Hopefully,
Right,
we
right.
could all buy our second homes.
Yeah, that's a second home. A second home. So a lot of our clients would call, oh, I need to buy a second home. But what they meant was, this, I have my first home. I want to buy another home. So is that second home? So my thing is, are you planning on buying in California? Are you planning on buying in Hawaii? Because you said second home. No, Ate Kathy, I want to buy another house. Okay.
Oh, okay. Second.
So you want to buy a second property are you going to live in that property? Are you going to exit your existing home? Or are you going to buy another house to rent it out? So there's different criteria, there's different, goals for our clients. So whatever your goal is, yes, you can buy a second home, but it has to be 200 miles away from your current home if your plan is a vacation home. But if you're planning on buying another house because everyone else is buying, another house so that they can rent out the other one, then that's considered investment. But if you're gonna move into that new house, then it's your primary. The other one then becomes your exiting property, becomes your investment property.
Because primary home requires a lot lower down payment,
A lot
like
lower
5%.
down payment.
Depends
But-
on your debt service.
And also,
But primary home also requires for you to live in it, where you go home after work every night.
So what type of loan would that be? Like, I know there's this person wanted to buy a second home. He could just drop down cash and it becomes conventional or something. But
You could
is
do
there
5% loan. You could do
5%?
if your existing home is conventional loan and you want to buy this house and you have only 3.5%, then go FHA.
You can go because
Yeah.
it's a primary
Okay.
home.
It's a primary
Still
home.
FHA, okay.
Yeah.
But if you're buying a second home, let's say you buy in Mount Charleston, how
Ju-
much typically is that?
So if you're gonna say that that's your vacation home, then you need at least 10% down.
10%.
10%.
Typically.
I just want to point it out to FHA because a lot of times, new home, never been in a house, never
Mm-hmm.
bought a house. FHA, they're probably thinking first home, 'cause-
First-time home
Yeah.
buyer,
So,
yeah.
can you tell us what FHA stands for?
Federal Housing Authority.
go.
So FHA is great if you don't have a lot of funds, your credit is not as where it should be. You have some student loans, you have some debts. The debt ratio, so first of all, debt to income ratio. Debt to income ratio is what you're making versus what you're spending. So what shows on your credit report, what's your housing payments gonna be?
Okay.
So that's where we base it on. I know a lot of our clients are like, what's that? What's our debt to income ratio?
Right.
Well, for example, if you're making $1,000 a month and you have a $300 car payment, the qualifying debt ratio is 50% most of the time. So realistically, you only have $500, diba? So $300 for your car, you only have $200 left for your house, assuming you don't have Victoria's Secret credit cards, you don't have, Capital One, you don't have all those debts, you didn't co-sign for anyone. So you really, realistically only have $200 left to buy your dream home.
Got it.
So that's what the debt ratio is. With FHA, we can go up to 60% depending on your compensating factor. Compensating factor is how much money do you have in the bank? How stable is your job?
Okay.
If how often are you switching your jobs? So those are the things, those are the key things that the underwriter looks at.
Okay.
So yeah, FHA is a great loan.
Yeah.
Mm-hmm.
A lot of factors come into play when you're purchasing a property because everyone is
lot.
just so different on their situation.
Yes.
So you need someone like Kathy to tell you.
I would always tell my client it's
Thank you,
stressful.
guys.
It's not like going to the store and buying stuff. It's a stressful process and having a professional like loan officer like Kathy right here.
The only thing, guys, I have to say, okay, so we have to mention this. With FHA, they cannot buy a flip property.
Oh yeah, it has to.
It has to be
What's
90
that?
days.
90 days.
Okay.
Flip properties. Some investors bought the house and they flip it. They sell it in less than 90 days, I
Yes.
think, Clark. Yeah.
Oh, and if you're the
yeah.
FHA buyer, you can't.
You
buy
can't. It has
Or
to.
FHA.
Yeah, it has to be the same owner for
it
the
go
last.
with VA too, or just FHA?
No, just
Okay,
FHA.
just
Yeah.
Because what they don't want to happen is that the investor buys the property and does a lot of renovations. Many times, if they're trying to save money or increase their profit, the quality decreases. Where we call that a lipstick on a pig.
Okay.
Like you have a house that's falling down, but hey, you repainted it.
That goes
you
back
know.
to where everything has to be.
Yeah, and you put in you put in a countertop that's too heavy for the base, that it's gonna fall down. So they don't want that house to be there for 90 days before the FHA buyer can put an offer on it. A conventional buyer, sure, they could, but they want the FHA buyer to make. They want that 90 days to happen, so that if there are problems that happen to that house after then they're pretty sure that if nothing happened in 90 days, the FHA buyer can do it. A lot of times these rules are written in blood. I think someone might have passed away or got injured because of flip homes, and that's why they come up with this.
Remember all those disclosures that you sign? Those are there because something happened.
Yeah.
Yeah.
So here in Las Vegas, there's speaking of disclosures, there's a special disclosure on golf courses here in Las Vegas that says that, hey, golf is a dying sport. If you buy a house with a view of the golf course, they could make that into houses instead, and that's because of a big lawsuit that's still happening currently over at Queens Ridge, because which ticked off a lot of rich people, and big lawsuit happened, and until now it's still there. Lawsuit also here in this sun whatever. We're in Northwest. That's also
Sun City.
They started building homes on the golf course.
No, they turned off. When the pandemic started, they closed the golf course.
Oh.
And there's a lawsuit by the homeowners because hey, we paid a lot of money just so we could get a view of a golf course, and now we can't even start a golf course because the Southern Nevada Water Authority and the Las Vegas Valley Water District does not allow new golf courses. And so what now? So that's that. So if you're purchasing property in golf courses, I also have a video of a house on the fairway, and there's like all these little holes on the on the stucco from the golf balls. And just a disclosure, if purchasing a property without looking at it, that might be something. So for investment properties, though, it's typically 20%, right?
20%, yes.
Okay, 20%
Yes.
down payment, and you can purchase, and there's no rule as to like how, if it's doesn't matter if you buy like just the next block away the house.
Yeah.
If it's conventional.
As long as you can credit, income, qualify, it's an investment home.
Gotcha.
You're good.
So next we see a lot of these advertisements that says, or even news report that says, hey, you got this low rate 2 years ago on a VA loan. You guys could assume the loan, because the property didn't increase that much in price, So you could do a VA assumption, and they put it on their, they put it on their ads. So has that happened to you?
Well, I've gotten a lot of calls. They're asking if they can assume someone's loan. How do I go about assuming someone's loan? Well, first of all, you have to go to the same bank that lent them that money for you to assume the loan. You don't necessarily have to be a VA.
Yes.
You can just assume it. It's just questions for me. I haven't really had anyone do it.
So, question with that. Let's say the seller is also purchasing a property. Now, I know VA, they have their benefits.
Right.
Let's say they use their benefit for a VA loan for this property.
Eligibility, yeah.
Are they still eligible, if they get that loan assumed, are they still eligible to buy another primary home?
Yes. So you can always, even if no one's assuming that loan, even if that VA loan is there, this is another misconception. Oh, I've already used it, I can't use it anymore.
Okay.
Yes, you can, as long as you're still VA eligible, as long as you still have that money. So we have this calculation. We calculate how much do you still owe, how much have you used. This is how much you can still use. This is how much you can still purchase.
Okay.
Yeah.
Okay, so they could still use it,
Yes.
but it gets reduced
So the
if
best
the
way-
VA loan is still there.
Yeah, the best way is if you're a VA and you're thinking of buying another house, don't get turned down right away. Don't be discouraged. Call a lender and ask. All we ask for is, we need your social security, we need your DD 214 to check, and it's really easy.
Okay, gotcha.
Yeah.
Call you.
Call me.
So also one thing about the assumption of the loan is that, let's say the seller has purchased this property, let's say 3 years ago at 2.5% interest rate. The property is $300,000, and then if you assume that loan, but the property is worth, let's say, $400,000 now, the loan was still like at $290,000, then you're purchasing at $400,000, then you're gonna have to come up with $110,000 as a down payment.
Yes.
So that's that. And also, I have a lot of the lenders that I spoke to, with a lot of the realtors who was doing the VA loan assumption, are having nightmares because it's taking a while. It's taking more than 60 days for a loan assumption.
It's rigorous, because think about it. This person is going to assume this loan, and you as the investor, you as the bank, you have to be really careful. Because if the interest rate right now is at 7%, this new buyer is only going to pay you 2.5. That's huge. They don't want that. Yeah, they don't want that. Would you? That's why they're making it as tough as possible for you to qualify.
Got it. So, again, when you're assuming a VA or what's it called, VA assumption,
VA assumption.
you're essentially the rate carries
The rate, that's
but
what it is. It's
the value of the home. will-
because it's kind of like hard place, right? It's like it's tough, because you as a seller, the value of your house is 400, but you only owe 280, and then you're gonna sell it to this someone at 2.5%, and then this someone too has to come in with 120,000. So it's a tough situation.
Okay, one more question I get from here is, what are HE loan and HELOC?
HE loan and HELOC. So home equity loan is based on the equity of your house. So it's just like you're cashing out. Your house is the collateral. So HE loan, you get the money in lump sum. They still need to do the appraisal. They still need to check your credit. Of course, they need to make sure that the equity is there.
Right.
They give you, let's say you need $50,000. You get that in lump sum. It's payable in either 15 years or 30 years, fixed interest rate. So your monthly payment every month.
Right.
So that's good for someone that's, let's say you have a
the money
student
right
loan.
away.
You're just going to pay it
Right.
off because, starting October, they're going to start charging you, I don't know, whatever it is, the interest rate on student loan, and you want to just pay it off.
Okay.
Home equity line of credit is a line of credit. You're approved for $50,000, but you don't have to use that $50,000 right away. You're going to fix your bathroom. You only need $10,000. So you take out $10,000, so you're only charged an interest on that $10,000 based on what you took out.
So it works pretty much like a credit card.
It's like a credit card. So I guess it
house is collateral.
exactly, and your house is the collateral. So it fits different needs, different people, different needs.
So the thing with the HELOC too is, let's say I got approved for $100,000 home equity line of credit. I don't need to use it right away, but depending on if I don't use it, depending on how the banks are, they could reduce it.
They could reduce it, they could just close it.
They could
right
just
away.
close it. Yeah, if you're not using it and they're not making money out of it. But it's good though. It's good to have that just in case.
Exactly.
For example, you find a house that's that's a great deal. You want to purchase it, but you're not that liquid, and you have a HELOC.
You can just use
You
it.
just use it, purchase the property, and then do a DSCR loan on it. I don't know, but
Exactly.
but you have it there. But you have it there when you need it. So many times, I think, which caused the crash in 2007, aside from ninja loans, no income, no job, no asset loans, is because people are getting loans from their houses or doing second loans to purchase things that are not assets.
Exactly.
They purchase things that are, a boat. They purchased the
Yes,
RV.
everybody had a
They
boat.
purchased, yeah. Aside from, buying 3 properties, 4 properties that are not income producing, just because they have a pulse, they have a house, they buy a house. So I think that's what caused the crash. But I want to hear it from a lender's perspective. In 2007.
It's really those high risk loans, the subprime, people that has.
What's a subprime loan?
It's people that has bad credit.
Okay.
Bad credit were given loans. People
Wow.
that no, they couldn't pay. They can't pay this monthly mortgage. They were given loans. There were just so many of those. No income, no assets, stated income, stated asset. As long as you have a driver's license, you can get a house.
Holy.
State your asset for me. You know,
they don't verify.
they don't verify anything. You were allowed to block off bank statements. Literally, you had to use a Sharpie to block off bank statements. You don't want to show this. I had a client who was a nurse. He had 18 homes.
Holy sh-
18 homes. He stated making $69,000 a month as a nurse.
18
So
homes.
yeah, those all foreclosed.
Yeah.
The funny thing is, if we know now what we knew then, he could have rented those homes out.
I know.
Yeah.
I mean, okay, the average in 2007, 2006, late 2006, the average price of a property was $330,000. So let's say those 18 homes those were $330,000. The average price for a house now is $440,000. So you're still up if you would have kept those homes.
Yeah.
Right.
Absolutely.
Yeah.
What drove what happened then? Oh, I know this the financial crisis. I don't know. What
Well,
was it
it's just really people got carried away.
Right.
People want more. People and there's no regulatory lending. There's no rules, basically.
So the other side of that, the people buying know at the end of the transaction or the closing, this is how much you're gonna be paying for this house.
They get carried away. They hear their neighbors buying another house, so
wow.
they have to have
loan for the down payment and closing costs. So
yes. We have 2 loans, the first and the second.
The second loan is for so they're coming up with zero money.
Zero
Zero,
money,
yeah.
and when it's like that, people are so greedy. It's predatory lending.
Right.
They would buy the house from the builder. They have their own appraiser. They have their own underwriters. So people would buy the house, first and second loans. A couple months later, they would cash out on that house.
Okay.
So when bad investment happened, they can't pay the house. The investors lose the value of that investment. They can't sell those. So
Well, how long-
the bank couldn't loan anymore. There's no money to lend. They had to close. The houses were foreclosed.
How long did that went? For the-
2004,
2006. Yeah, it's a few years.
And a lot of people who are predicting a market crash in 2020 are saying, and then you ask them, okay, what made you want to say that there is the housing market crash? Oh, there's economic recession. Economic recession does not mean a housing recession.
Do you see it anytime soon?
There's
There's no houses right now.
No.
There's no indications for
There's none.
market crash.
No, and I feel like people are smarter now.
Yeah, we learn.
The banks our guidelines are really tough, so again, I tell our buyers, because I know sometimes they get irritated that we're asking more documents, and it's just we're protecting everyone. We're protecting you, we're protecting the bank. That's why if you say it, prove it. How do you prove it? We need to see your documents.
Yeah. And one interesting is happening right now is, during the 2007 8, 9 to 2000. Okay, a lot of things changed in 2011, where the AMCs started happening in
Right,
2011. But when those happened, a lot of people lost their homes.
Yes.
So a lot of the children at the time saw their parents struggle, lose their cars, their boats, their RVs, they move from the house, they have to walk away from a 8-bedroom house to a 2-bedroom apartment, because that's the only place that approved their parents. So it kind of affected them in a way. These are millennials now.
Yeah.
It kind of affected them in a way that that states, I don't want this to happen to me. I don't want this to happen to my friends. So I'm going to be smart about my money.
Right.
So now the age of home buyers, the most first-time home buyers, and are getting younger and younger, and these are just
Exactly.
on their 30s, right?
Yes.
I think because of what happened there, they got a lot smarter now. And also what happened in 2020, 2021 was that while there was an economic recession happening, the real estate was booming. So now people are seeing that real estate is a pretty solid investment. It's the investment that that beats recession. It's an investment that's better than gold in terms of its value. And also, if you have investment properties, like we said on our podcast, you could if you're paying a lot of money, a lot of taxes on your W-2, but if you have investment properties and you know how to report your taxes properly, you're using what the government is stating that you need to use, and you're reporting your taxes, your insurance, your repairs, your management fees, and you're able to use depreciation on those properties. You're able to use you could do a that study, the where they use the depreciation, but yeah, so if you're able to take advantage of what the government is allowing you, because the government's giving you a lot of incentives if you're providing employment or if you're providing housing. A lot of the stuff that's being used on these properties are tax deductible because you are providing housing, and that's what so you're incentivized by the government. If you don't know how to report those, then you're overpaying for your
Then you
taxes.
should learn how to do
You should
it.
learn how to do
You
it,
really
yeah.
should learn how to do it. When you said depreciation, when you're buying a house, we typically can use that. We can put that back as an income for you for qualification for your depreciation.
Yeah.
Is that also something that is in your area?
When we're doing loans,
Yeah.
and this is your reporting versus what we're looking at, we look at your tax returns,
Okay.
and then sometimes when we see depreciation, we can use that back. That's also part of your income.
Yeah. One accountant told me depreciation is like magic.
Yes.
It's like making money out of nothing. There's a certain there's a certain percentage that's given towards properties when they're calculating for depreciation. This is for investment properties. It's like reducing the taxable income that you're supposed to pay. And for someone that's why a lot of people from California are purchasing investment properties here, because it's cheaper here, but also because they could, if they're supposed to pay, like, let's say $20,000 extra in their taxes, but they have rental properties, and then they make use of those advantages for owning rental properties, they could reduce that and have instead of paying, they could probably get something back if they know how to use it properly. So,
One thing I have to say though is, if you're planning to invest and you're planning to rent out your house, before you file your taxes, consult with a tax consultant, or maybe just ask us first, because the thing is, if you want, say you have 2 houses and you've been renting out that one house, but you're not reporting it on your taxes, we have to show that you've been a landlord. We have to show on your tax return that you've been renting out the property. Otherwise, Otherwise, I can't use the rent on those properties. I can only use the rent on your exiting, meaning the house that you're currently living in, and it's only to offset the payment of that house. So this house, house A, that you've been renting out for a year, but you didn't report on your taxes, I'm sorry, you're gonna get hit by the debt ratio, assuming you have a monthly payment on that house. Or if that's paid off, you're gonna get hit with taxes, insurance, and HOA if it has any HOAs, because you're always paying for taxes and insurance. So even if you're reporting $5 as income on that property, put it on your Schedule E. You have to show that you are a landlord, that you're renting out your house. Otherwise, it's gonna bite you in the end. If you're not sure, call us, call me, you know.
Consult your tax.
Consult your tax
looking to
preparer.
appraise the property, you need to consult the lender and your
Yes.
accountant, and they work hand in hand to get you prepared for it. And misconception on people who are in the Filipino community. I see a lot of people who are renting out the property, but they don't report it.
Report it, please.
But because they think that they could save on taxes. No, it's the opposite.
Exactly.
Like if you're knowledgeable on the tax incentives of being a landlord, you're the number one who would be reporting it, because a lot of times it would help you on your taxes, and it would make, that's the difference of paying in taxes and getting refund in taxes.
Yes, and if your goal is to buy multiple homes, you have to show that, hey, I have multiple homes. I've been a landlord. My houses are being rented. Because if it's not, I'm sorry, I can't use it.
Yeah.
Yeah.
Yeah. So, you have more questions on your client?
What would you advise a client if they say, because we hear this a lot of times, and they're scared of the word pre-approved, right? So the first thing they say is, "Oh, I'll wait next year when the interest rate is gone. It's probably gonna go down, or gonna go down." Like,
The
it's a
$1,000,000
fact,
question, right?
Yeah. So what advice would you give? Would you give those clients if they were like talking?
It's never a bad time to buy a house. If you've been thinking about it, go buy it.
Right.
Buy it. Because think about it, when the rates are down, you're competing with more buyers. More buyers will get
And
approved.
investors.
And investors, they're gonna snatch those houses. Right
Yeah.
now, I'm pre-qualifying our clients, and the rates are so high, I don't think I should buy. No, you should buy now. Because the minute the rate dips down, here comes everybody buying houses from California, buying houses from Hawaii. They're gonna buy those houses with more down payments. They're gonna buy them, and you're just gonna be competing with more buyers, and
California
you're the bidding war.
Yeah.
So you have a little bit of a lower rate, but now you're gonna come in with an extra 50,000, extra 30,000 for that same house that you should have bought a couple months ago.
Nice.
Yeah.
So we tell them, like I always say to my client also, and this one is the matter of the house, the price of the house. They would always say, "I'll wait when the price of the house is gonna go down."
It hasn't gone down. It's only going up. It has not gone down.
I tell them, like, I don't know. Ever since I found out about home prices, I've been in Las Vegas for 20 years. It's been going up.
It's been going up.
So I think we go with the trend.
It's
It just
not-
follows the stock.
Have you seen
It's
Clark's
like a graph that
post?
goes up.
How many things are they building in Las
Yeah.
Vegas? How many sports are they? I
Right.
don't think Las Vegas is gonna slow down anytime soon.
It's
And-
still about to go up.
Yeah.
It hasn't reached that potential. We still have the F1 coming.
Yeah.
The Sphere is opening up, and we have the Boring Company making faster transportation from the airport to the stadiums to the
And we get the high-speed train.
Yeah,
Yeah, I mean,
and
we
they
have-
already started that,
Yeah.
and that's like a $10 billion project, $5
It's-
billion project.
Yeah. So besides all that, the more important thing I always tell my client is, if you're gonna buy a house to live in, and enjoy in the next 30 years, I don't think the price matters. And I also didn't think that the interest rate matters also, because the interest rate
Well,
fluctuates.
sometimes it depends on their comfort level, diba?
Right.
It's what I tell them is bite the bullet. Even though the interest rate is a little bit higher right now, you may have to cut down on shopping a little bit,
Right.
to afford the monthly payment. We refinance when the rates are lower, but make sure that you keep your credit good, your debt ratio low. Your car does not have to match the color of your door.
Right.
You don't have to buy the brand new car just because you have a brand new
Brand new
house. You don't have to have a brand new couch. Get your house, keep your debt ratio low, and keep your credit good. Then we refinance it when it's lower. At least you have your house.
So that's from Kathy. Continue to be financially smart.
Yeah.
And that's what we are. I mean, that's what we're all about, is to be smart buyers, smart investors.
Right.
Here in Las Vegas, and that's what the CK team wants to impart to our readers and to our clients and future and past clients. So one more question is, what are the projections by lenders on the lender side on interest rates? Are they coming up, coming down in the next few months or sometime next year?
So they pretty much said that in September the Fed is going to do another raise on the rates. Yes, next month. And if that happens, then the rate will stay higher. But if it doesn't happen, then the investor will pretty much feel a little bit secure, so it might go down a little bit, which
Okay.
would be great for us.
Okay,
Yeah.
very cool. It's also election time next month, next year. So a lot of times,
A lot of times when it's election time,
they want to show that the economy is doing good,
Yes.
so they
So-
reduce the interest
The
rates.
projection is by early spring of next year, the rates would go down a little bit. So guys, get your house now, because like I said before, when the rate goes down, there's going to be more buyers.
When the rate goes down, the affordability goes up, demand goes up, price goes up.
exactly.
Just explain to our future clients that the price of getting pre-approved in the loan price and everything is not between me as a realtor and the client. It's actually just between you and them, right? Like,
Yes.
we don't see any of the
Exactly.
Yeah.
I don't discuss your finances
yeah.
with the realtor unless you give us permission. They actually don't know how much money you have.
There you go.
Clark would always say, "Are they okay, ate? Are they will they?" I said, "Okay, they're good."
Yeah.
You don't see, the realtors do not see any finances. Those are private. They
Thank you.
stay with me.
And we don't want to know either.
And they don't want to know anyways. They never want to know.
Yeah, we cannot see any confidential information.
Right. Those are strictly for us only, the lenders.
All right. Well, thank you very much, Kathy, for all your time. It's been an hour, and hopefully for all the viewers out there, this gave you a lot of information. If you have any questions at all regarding loans, if you want to refinance, purchase a property, you can contact us directly to Kathy. You could also contact Kathy directly.
Yeah. Tell them your email or your podcast.
It'll be on the screen. All right. Thank you very much, guys. Have a great day. Goodbye.
Thank you.
Thanks, guys.